In March 2000, a 37-year-old marketing manager in Seattle put his entire life savings into a single tech stock. He wasn't gambling. He'd done his research. He believed in the company. For a while, it looked like the perfect decision. The stock climbed 300% in less than 2 years. He felt like a genius. Then the bubble burst. By 2002, his investment was worth $5,000. He had lost more than 90% of everything he had invested. Maybe you recognize yourself in this story, and you were not alone. It happened to millions of investors at the same time. Across the dot-com crash, the 2008 financial crisis, and the crypto collapse of 2022, the same pattern, the same mistakes, repeated by different investors. And here's what most investors didn't realize. The exact mistakes they were making had already been identified, studied, and explained decades earlier, in 1949, by an economics professor named Benjamin Graham. His book, The Intelligent Investor, is widely considered the most important book ever written about investing. Warren Buffett read it at 19 years old and still calls it the best investing book ever written. In this video, we'll uncover 6 mistakes Graham identified that destroy ordinary investors. If you understand them, you won't just survive the next crash. You'll profit from it. Let's go through them one by one. Mistake number 1. Confusing speculation for investing. Most people think they are investing, but what they are actually doing is speculating. And that confusion is responsible for millions of losses in every market cycle. Benjamin Graham defined the difference in 1934, and the definition still holds today. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. 3 conditions: thorough analysis, you understand the business you're buying; safety of principal, the money you invested is unlikely to be permanently lost; adequate return, a reasonable profit relative to the risk you're taking. If any one of those is missing, you're not investing, you're speculating. Remember the feeling in 2021 when a random cryptocurrency could double in a week? You see a token that has already gone up 400% in 3 months. Everyone's talking about it, so you buy it. Have you done thorough analysis? No. Is your principal safe? No. Is there any promise of an adequate return based on the real value of the business? No. That's speculation. Or imagine a hot IPO. If you're not familiar with the term, it's when a company sells its shares to the public for the first time. A startup launches a new electric vehicle and promises to revolutionize transportation. The media calls it the next Tesla. Investors rush in, so you put $5,000 into the stock. Thorough analysis? None. Safety of principal? 0. The price was set by investment banks whose job is to get the highest possible price for the seller, not the buyer. Adequate return? Unknown and unknowable without analysis. Speculation. Now Graham wasn't against speculation. He knew that people will always speculate. And sometimes it even works. The real danger is when people believe they are investing when in reality they are speculating. Because when you speculate, you are competing against people who do this professionally. They have better data, faster execution, more capital, and decades of experience. You're not playing the same game. You're playing against people who built the game. And Wall Street knows it. That's why everyone is called an investor. Why financial media makes trading feel urgent and exciting? Because your activity generates fees. The more you buy and sell, the more they earn. Graham's practical solution is simple. Keep 2 separate accounts, one for real investments, companies you've analyzed carefully and bought at a price below their true value, and a second, much smaller account for speculation. Graham suggests no more than 10% of your portfolio. That account is for bets, experiments, curiosity, and never mix them. One is your financial future, the other is entertainment. But even when people understand this distinction, they still lose money. Because the investor's greatest enemy isn't the market, it's themselves, the way the market makes them feel. Mistake number 2. Letting the market control your emotions. Let me introduce you to the most useful character in the history of finance. His name is Mr. Market. But first, you need to own something. So let's say you bought a 10% share of a small bakery down the street. Nothing fancy, just a real place. Flour on the counters, a line out the door on Saturday mornings, an owner who's been doing this for 20 years. You invested $1,000. You looked at the numbers. You know what it's worth. And because you own a part of this bakery, you now have a business partner. Mr. Market. Every single morning, he knocks on your door, coffee in hand, smile on his face, and makes you an offer. He'll either buy your share of the bakery or sell you more of his. The first few weeks, he seems completely normal. His offers stay right around what you paid. Then, one Thursday morning, he shows up in a suit, practically vibrating with excitement. "I'll give you $1,400 for your steak," he says. "Bakeries are the future. Everyone's eating bread. This thing is going to the moon." You look at the bakery. Same ovens, same recipes, same Saturday line. Nothing has changed. 3 weeks later, different man entirely. He's at your door at 7 a.m., unshaven, looking like he hasn't slept. "I'll take $600 for my share." Bad news out there. Economy's turning. People are cutting back on carbs. You look outside. The bakery is full. The smell of fresh bread is drifting down the street. The owner just hired 2 new people. Still nothing has changed. And here's what you start to realize. Mr. Market was never rational. He's emotional and completely ruled by whatever he read in the news that morning. Now ask yourself, should you let Mr. Market's mood determine the value of your investment? Of course not. His emotions have nothing to do with the real value of the business. But here's the thing. Mr. Market is actually useful. When he's irrationally pessimistic and offers to sell you his share worth $1,000 for $600, you buy. When he's irrationally optimistic and offers to pay $1,400 for something worth $1,000, you sell. And the rest of the time, when his prices seem reasonable, you close the door, pour yourself a coffee, and ignore him completely. Mr. Market is simply the stock market itself, and most people react to him the same way. When prices rise, they feel like geniuses. When prices fall, they panic. Graham summarized this idea with one of the most famous sentences ever written about markets. "In the short run, the market is a voting machine. In the long run, it is a weighing machine." In other words, in the short term, prices reflect popularity and emotion. But over time, they reflect the real value of the business. And history gives us many examples of how wildly wrong the market can be in the short term. Take A&P, the Great Atlantic and Pacific Tea Company. In the 1920s, it was the largest grocery chain in America, profitable, established, and deeply rooted in American retail. In 1929, at the height of the bull market, A&P's stock reached $494 per share. Then came the crash. By 1938, the stock had fallen to $36. At that price, the entire company was valued at $126 million. But Graham noticed something remarkable. A&P's current assets alone, just its cash, inventory, and receivables, were worth $134 million, including $85 million sitting in cash. In other words, the market was pricing the company below the value of the cash and assets it already owned. According to Mr. Market, all of that had negative value. Why? Not because the analysis supported it, because investors were afraid. Fear spreads through markets like a virus. The intelligent investor who understood that Mr. Market was panicking bought A&P at $36. By 1939, the stock had recovered to $117. But the story doesn't end there. By 1961, A&P's stock had climbed all the way to $705. The market had swung to the opposite extreme. Investors were now paying a price far higher than the company's real performance could justify. Mr. Market had gone from terrified to wildly optimistic. And once again, the crowd was wrong. By 1970, the stock had fallen to $215. By 1972, it had dropped further to $180. The business had not changed nearly that much. The psychology of the crowd had. That's the real lesson of Mr. Market. The price you see every day is not a verdict, it's an offer. And the intelligent investor knows when to accept it and when to ignore it completely. Mistake number 3, following the crowd. When the financial news is full of positive headlines, when the market has been rising for 2 years, then 3, then 5, when your friends, coworkers, and neighbors are all talking about their latest winning stocks, and suddenly it feels like everyone is making money. At that moment, the most natural thing in the world is to do what they're doing. That is exactly when the crowd destroys you. Graham studied 100 years of market history for this book. A full century of data, booms, crashes, wars, recoveries, bubbles, and he discovered that markets follow the same pattern again and again. Markets swing between two states, euphoria and despair, greed and fear. And the crowd is always most confident at exactly the wrong moment. For example, from 1900 to 1924, the market was quiet. Nobody was particularly excited about stocks. They were a financial tool, not a national obsession. Then came the 1920s. New technologies were transforming American life. Companies were posting record profits and the Dow was going vertical. Gradually, then all at once, everyone was in. Taxi drivers were giving stock tips. Banks were lending ordinary people money to buy shares. Newspapers printed market results like sports scores. Investing wasn't just profitable, it was fashionable. By 1929, Graham had already recognized the warning signs. Prices at historic highs. Investors paying extremely high prices relative to company profits. Investors receiving smaller dividends relative to the price they pay. Heavy speculation using borrowed money. And a wave of poor quality companies going public at inflated prices. Graham later observed that these signals appear before almost every major market bubble. Check all 5 boxes and you're standing in the middle of one. Then the bubble bursts. In October 1929, the market collapsed. Over the next 3 years, the Dow lost nearly 90% of its value. Thousands of banks failed. Unemployment reached 25%. The Great Depression followed. For years, the crowd looks right. Everyone seems to be making money, and by the time you realize something is wrong, it's already too late. This sounds backwards. We are wired to believe popularity signals quality. But markets are not restaurants. When a restaurant gets popular, more people can eat there. When a stock gets popular, the price goes up. And a higher price means lower future returns for anyone who buys it now. Popularity is self-defeating in investing. By the time the crowd has fully embraced something, most of the gain is already gone. What's left is the risk. Graham put it simply, high prices equal more risk. He studied many pairs of companies over decades and found the same result again and again. The popular, exciting, widely loved stock often delivered worse returns than the boring, ignored alternative. And there is one specific crowd behavior Graham warned about more than any other. IPOs. That's when a company sells its shares to the public for the first time. And when a company decides to go public, it chooses its moment. And that moment is almost never when prices are cheap. It happens when enthusiasm is high and investors are willing to pay maximum prices for a good story. The founder wins. The investment bank wins. The early investors win. And the person buying at the IPO price is usually the one paying the highest price. Graham had a joke about what IPO really stands for. It's probably overpriced. Imaginary profits only. Insiders' private opportunity. Companies go public when conditions favor the seller. By definition, that means they are unfavorable for the buyer, every time. So how does the intelligent investor defend against the crowd? Not by being a contrarian for its own sake, but by staying anchored to one simple question the crowd rarely asks. What is this business actually worth and what am I paying for it? When the price you're paying is far above what the business is worth, no matter how exciting the story, the intelligent investor steps back. Graham also observed that the most successful investors shared one trait above all others: discipline. They refused to change their approach simply because it had become unfashionable, and they paid very little attention to what the market around them was doing. You've done the work. You've identified a genuinely great company. You've ignored the crowd. You believe in the business. And then you buy it at the wrong price. Mistake number 4, overpaying. You feel like an investor. You studied the company, you understand the business. The price feels justified. But the price is never just a number, it is one of the biggest factors determining your future return. Buy a great company at the right price, and you build wealth. Buy the exact same company at the wrong price, and you destroy it. The price of a stock comes from two forces working together: math and emotion. The math comes from the business itself, revenue, costs, and profits. The emotion comes from the market, what investors believe the future will look like. And the price of a share sits exactly at the intersection of those two forces. Imagine a coffee company. In 1 year, it sells $10 million worth of coffee. To run the business, it pays for coffee beans, salaries, rent, marketing, and taxes. Those costs total $8 million. So the company's profit is $2 million. Now imagine the company has 1 million shares. So profit per share becomes $2 per share. That means each share represents a small ownership piece of a business that produced $2 profit this year. And when you buy a share, you are buying a piece of that business. Not just this year's profit, but the profits that piece of the company may generate in the future. If investors believe this growth will continue, they start imagining a much more profitable future. And that belief affects what they are willing to pay today. Two investors might look at the exact same company. Both see $2 of earnings per share today, but they see the future differently. The first investor expects moderate growth. They imagine profits increasing slowly. Because the outlook is steady but not extraordinary, they might pay about 15 times the company's yearly profit. So if you multiply $2 by 15, the stock price becomes $30 per share. The second investor sees a much more exciting future. They imagine profits growing much faster. When the story becomes exciting and growth looks unstoppable, investors often pay much more. Instead of paying 15 times the company's current yearly profit, they might pay 40 times earnings. So when you multiply $2 by 40, the stock price becomes $80 per share. The business has not changed, the earnings are still $2, but the price changes because expectations change. The problem is that the future rarely unfolds exactly as expected. Suppose the optimistic growth investors were expecting doesn't fully materialize. If profits grow more slowly, like the first investor imagined, the company is still growing. It's still a healthy business. But the growth is not fast enough to justify paying $80. And suddenly the price they paid no longer makes sense. The stock might fall from $80 to $40, even though the company itself is still doing fine. This is the lesson Graham wanted investors to understand. Great businesses can still be terrible investments if you pay too much. He reframed the problem completely. Instead of asking, "How fast will this company grow?" Ask, "How do I protect myself if my analysis is wrong?" He called these two approaches projection and protection. Most investors rely on projection. Intelligent investors focus on protection. Graham's answer is cold water in the face. Investing on the basis of projection is a fool's errand. Even the forecasts of so-called experts are less reliable than the flip of a coin. So how do you actually value a company without predicting the future? Graham suggested focusing on things that can actually be known. First, long-term prospects. Where did the company's profits come from? Is that source of profit likely to still exist 10 years from now? You don't need perfect forecasts. You need a reasonable understanding of whether the business is durable. Second, management quality. Look at past annual reports. What did management promise 3 years ago? Did they deliver? And when they failed, did they admit it honestly? Or did they blame the economy, uncertainty, unexpected market conditions? Managers who take responsibility are revealing something about their character. Managers who always blame external forces reveal something else. Third, financial strength. A healthy business generates more cash than it consumes. Look at the company's cash from operations, the cash the business generates from its normal activities. Has it been positive for many years? If so, the company can fund itself. It doesn't need constant help from banks or investors just to survive. That independence is extremely valuable. Fourth, dividend record. Has the company consistently paid dividends over many years? A company that has paid dividends for 20 consecutive years has already survived recessions, competition, and economic shocks. That track record is one of the most reliable signals of a durable business. Fifth, current dividend rate. How much income does the company pay shareholders today? If a company pays a $3 annual dividend and the stock costs $100, that's a 3% return paid directly to shareholders. That income is real cash, not a forecast. The goal isn't to find the highest dividend. The goal is to buy a strong business at a reasonable price with a dividend that pays you while you wait. Historically, many stable companies paid dividend yields between 3 and 6%. From all of this, Graham arrived at a simple rule. There is no such thing as a good stock. There are only good prices. The price you pay today is the one variable you completely control. You cannot control the economy or the market, but you can control the price you agree to pay. Graham's framework for protection is simple. Pay a reasonable price for businesses you understand. Use multi-year earnings averages. Look for companies with strong finances and long dividend records. And when the investment only works if the future turns out perfectly, walk away. You now know 4 mistakes: confusing speculation for investing, trusting the market price, following the crowd, overpaying. But even if you avoid all 4, there is still one way investors get destroyed: when they put too much money into too few investments. Mistake number 5: ignoring diversification. There is a trap that catches many careful investors. They analyze a company. It looks undervalued. They believe strongly in it. So they put half their portfolio into it. It feels like conviction, but it's a bet. And the moment something unexpected happens, half their portfolio disappears. Let's look at Penn Central. In 1968, Penn Central was the largest railroad company in the United States. It was widely seen as a stable, established company. The stock traded around $86 per share. For many investors, it looked like a safe place to concentrate their savings. After all, this was Penn Central. What could go wrong? But by 1970, the stock had collapsed to about $5. Penn Central had filed for bankruptcy, the largest corporate bankruptcy in U.S. history at that time. Investors who had concentrated their portfolios in the stock didn't just lose money. They lost almost everything. And the warning signs were there. The company was barely able to cover the interest on its debt. It hadn't paid taxes in years, suggesting its reported profits were questionable. And its operating performance was worse than its competitors. But even careful investors can miss warning signs. The real problem was not just the analysis, it was concentration. When too much money is placed in a single investment, there is no room for error. One mistake becomes a permanent destruction of capital. Benjamin Graham understood this better than most. During his career managing money, his investment fund often held over 100 stocks simultaneously, not because he was uncertain about each individual pick, but because he understood that even correct analysis produces wrong outcomes sometimes. The future is genuinely uncertain. A company can face unexpected problems: a new competitor, a regulatory change, a management mistake, or an industry disruption. Diversification protects you from that uncertainty. If you hold 20 different investments, one failure is painful, but manageable. If you hold only 3, a single failure can destroy a large portion of your wealth. The question is not whether you will ever be wrong. You will. The question is whether one mistake can wipe you out. Graham built entire strategies around diversification. One of the clearest examples was his approach to what he called net-net stocks. A net-net stock is a company trading below its net current asset value. The formula is simple. Take the company's current assets, its cash, inventory, and money customers owe it, and subtract its total liabilities. Now compare that number to the company's stock market value, also called its market capitalization. Market capitalization is calculated by multiplying the stock's price by the total number of shares the company has. If the net current asset value is higher, the market is valuing the entire company for less than the value of its liquid assets. In other words, the company's cash, inventory, and the money customers owe it are worth more than the price investors are paying for the company. That gap protects investors. Even if the business struggles, the underlying assets can limit the losses. These situations exist because markets sometimes become extremely pessimistic about a company or an entire sector. Of course, some of these companies are cheap for a reason. Some are declining. Some have poor management. Some will even go bankrupt. Graham accepted that. So his rule was simple: no single company should have the power to destroy your portfolio. Hold between 10 and 30 stocks spread across different industries and economic environments. 10 stocks in the same sector is not diversification, it is concentration. When that sector turns, and sectors always turn eventually, they all fall together. 5 mistakes down, 1 to go. And the 6th mistake is the one Graham called the most important concept in all of investing. The one that, if you understand it deeply, makes every other principle click into place. Mistake number 6: forgetting the margin of safety. As Graham explained, if the secret of his entire philosophy had to be reduced to a single principle, it would be this: margin of safety. He called it the master concept of investing, because it is the only principle that explicitly acknowledges the most important truth in investing. You will sometimes be wrong, not because you failed to analyze, but because the future is genuinely uncertain. That is why Graham insisted every investment must include protection. The margin of safety is what protects you when reality turns out worse than your expectations. This idea exists in many fields. Engineers understood it long before investors. When engineers design a bridge, they don't calculate the expected load and build the bridge to support exactly that weight. If a bridge is expected to carry 10,000 tons, it might be designed to hold 30,000 or even 40,000 tons. Why? Because calculations contain errors. Materials can have hidden flaws. Conditions change. Unexpected stress occurs. The difference between what the bridge can handle and what it needs to handle is the margin of safety. Investing works the same way, and Graham used the concept of margin of safety at two different levels. First, at the level of an individual company. When you analyze a company and conclude it's worth $100 per share, that estimate depends on many assumptions: future earnings growth, competitive pressure, management decisions, economic conditions. Some of those assumptions will inevitably be wrong. If you pay $100 for something you believe is worth $100, your analysis must be perfect just to avoid losing money. It won't be. But if you buy the same company for $65, something interesting happens. Your analysis can be partly wrong and you may still earn a good return. That $35 gap between price and value is your margin of safety. It protects you when reality turns out worse than expected. And if your analysis turns out to be correct, the return can be exceptional. Second, Graham often looked at margin of safety from a broader perspective: the overall market. Investors often compare two classic choices: safe bonds and stocks, which are riskier. So the question becomes simple: how much extra return are stocks offering compared to safe bonds? For example, imagine a stock that earns $9 for every $100 investors pay for it. That means the earnings yield is 9%. Now compare that to safe bonds. If bonds are paying 4%, stocks are offering 5% points more return. That extra return is the margin of safety. It acts as a cushion that compensates investors for taking the additional risk of owning stocks. But sometimes the situation reverses. If stocks yield only 3% while bonds pay 4%, the margin of safety disappears. Investors are taking more risk while earning less than the safe alternative. This situation often appears during periods of economic prosperity. Prices rise, companies look strong, and investors feel confident. But as prices rise, the return investors get from stocks quietly falls, and that is exactly when the margin of safety disappears. This is why margin of safety is not just a calculation. It is also a mindset. It requires the discipline to rely on your own analysis, even when the crowd is moving in the opposite direction. As Graham wrote, "You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right." At its core, investing is not about being right all the time. It is about managing risk. The psychologist Paul Slovic once described risk as having two components: probability and consequences. Before making any investment, ask yourself two questions. What is the probability that my analysis is wrong? And if I am wrong, then what happens to me? When investing, a margin of safety does not guarantee you will be right, but it reduces the consequences if you are wrong. It limits the damage when the unexpected happens. Graham summarized the principle this way: the intelligent investor must focus not just on getting the analysis right, you must also insure against loss if your analysis turns out to be wrong. 6 mistakes, all identified by one man in 1949, and all still destroying investors today in every market cycle. So what does Graham actually tell you to do instead? He gives you two paths, and the most important decision you will make as an investor is which one fits you. Path 1. The defensive investor. This is the path Graham recommends for most people. The defensive investor accepts a simple truth: beating the market consistently is extraordinarily difficult, even for professionals. So instead of trying to outsmart the market, they aim for something more realistic: steady growth in their money, earned patiently over decades. Their approach is disciplined and straightforward. Own strong companies. Diversify broadly. Maintain a balanced portfolio between stocks and bonds. Invest regularly and avoid reacting to short-term market noise. Follow the rules even when they feel boring. At times, it will underperform when speculation is booming and everyone else seems to be making easy money. But staying disciplined during those moments, that is the entire job. Path 2. The enterprising investor. The second path is harder. For most people, it is essentially a second job. It demands time, effort, and intellectual honesty. Enterprising investors search where others are not looking. They buy strong companies when they are temporarily unpopular. They look in neglected industries. They investigate companies that appear deeply undervalued, including Graham's famous net stocks. But this path requires serious work and the discipline to stay rational when markets become emotional. Graham summarized his philosophy with a simple observation. Achieving satisfactory investment results is easier than most people think. Achieving superior results is harder than it appears. If you want satisfactory results, meaning steady growth, preserved capital, and wealth that compounds over time, this path is available to almost anyone. Understand the 6 mistakes. Avoid them. Be patient. Follow the rules even when they feel boring. But if you want superior results, the difficulty increases dramatically. The analysis must be deeper. The temperament required is rare, and the discipline must last not for months or years, but for decades. Warren Buffett read this book when he was 19. More than 70 years later, he is still applying the same principles. Through the dot-com bubble, the 2008 crisis, the crypto mania, Buffett's wealth rests on a simple idea: avoid these mistakes. The market will always swing between fear and greed. Mr. Market will always knock on your door with irrational offers. The only question that matters is this: will you take advantage of him, or will you let him take advantage of you?